$50,000 is a crucial financial milestone for any Canadian investor. It is enough capital to generate serious momentum, but one wrong move can set you back a decade. Today, we are settling the ultimate debate for 2026: rental properties versus index funds. For generations, the default financial advice in Canada has been to buy real estate as soon as you possibly can. The cultural obsession with property ownership is deeply ingrained in our society. However, the economic landscape of 2026 is vastly different from the environment our parents operated in. We are dealing with elevated mortgage interest rates, strict lending stress tests, skyrocketing property taxes, and a cost of living crisis that puts immense pressure on tenants. Against this backdrop, broad market index funds have emerged as a highly compelling, stress-free alternative. To determine which path is actually best for your $50,000, we have to look past the emotional attachment to bricks and mortar and focus entirely on the mathematical realities of both asset classes. Let us begin by mapping out the real estate trajectory. With exactly $50,000 in cash, assuming you need a 20% down payment for an investment property, your maximum absolute purchase price is $250,000. In major metropolitan hubs like Toronto, Vancouver, or even Calgary, finding a viable cash-flowing property at that price point is mathematically impossible. You are forced to look at tertiary markets or smaller prairie towns. Let us assume you find a small condominium or a dated townhome in a secondary market for $250,000. The greatest advantage of real estate is financial leverage. You are using the bank's money to multiply your exposure to the market. Your $50,000 now controls $250,000 asset. If that property appreciates by a historically average rate of 3% per year, the asset gains $7,500 in value. When you measure that $7,500 gain against your original $50,000 investment, you are actually achieving a 15% return on your initial capital, not including the principal paydown from your tenant paying the rent. This is why real estate creates millionaires. Leverage accelerates wealth creation in a rising market. However, the real estate math in 2026 hides vicious liabilities. You must account for land transfer taxes, legal fees, appraisal costs, and property inspections just to acquire the asset. Once you own it, you face monthly condo fees that increase every single year, property taxes, insurance, and the ever-present threat of maintenance emergencies. A single broken furnace or a special assessment on a condominium roof can instantly wipe out 3 years of profit. Furthermore, if you get a bad tenant or the property sits vacant for 2 months, you are personally responsible for the entire mortgage payment out of your own pocket. Real estate is not passive income. It is a highly illiquid part-time job that requires constant management and capital reserves. Now, let us examine the index fund alternative. If you take that exact same $50,000 and deploy it into low-cost, broadly diversified exchange-traded funds, the mechanics of your wealth creation change entirely. First and foremost, you can shelter this money from the government. By utilizing your tax-free savings account or your registered retirement savings plan, your investments can grow, compound, and pay dividends entirely free of tax. With index funds, there is absolutely zero leverage. Your $50,000 only controls $50,000 worth of equities. However, assuming a conservative, historically accurate annualized return of 7%, your money compounds quietly in the background. In 10 years, without you lifting a single finger, that $50,000 will grow to nearly $98,000. You will never receive a phone call at 2 o'clock in the morning because a pipe burst. You will never have to evict a tenant, deal with municipal bylaw officers, or negotiate with a contractor over the price of drywall. The most powerful advantage of the index fund strategy in 2026 is absolute liquidity. If an emergency strikes, or if a massive new opportunity presents itself, you can open your brokerage application, sell your shares, and have the cash deposited into your checking account within 48 hours. Try liquidating a rental property in 48 hours. It takes months and costs you tens of thousands of dollars in real estate agent commissions and legal penalties. Ultimately, the decision comes down to your personal risk tolerance and your desire to actively manage your wealth. If you want a part-time job that offers the potential for highly leveraged, tax-advantaged gains, real estate remains a powerhouse. But if you want true passive income, high liquidity, and absolute peace of mind, the stock market is the undisputed champion. To model your own specific numbers and see exactly how compound interest compares to real estate appreciation over a 20-year timeline, go to www.northcalc.com and use our free investment comparison calculators. Make sure you run the math before you lock up your life savings. If you enjoyed this head-to-head financial comparison, click over to my previous video where we exposed how the new 2026 electric vehicle tariffs are destroying used car values across Canada.